In today's video, we're going to do a bit of a follow-up on the S&P 500. Since the last time we looked at the SPY, our plan has unfolded according to the way we expected. When we broke outside of the shorter-term uptrending channel, we made a note that, hey, this is where we think SPY is likely to resume this longer-term downtrend. That's the downtrend formed from this broader channel right here. We had tagged the top of it. We had broken outside. We expected one more retest. We got that retest. We took advantage of this move right here using that double calendar spread inside of Burlingame. And since then, we've really had the S&P fall almost like an elevator in free fall for the past 4 days now. 1, 2, 3, and 4 after that gap up right here. Now the question comes in, where are we expecting the S&P to fall to? And how do we take advantage of this new trend if you haven't already gotten in? Now for the second question, I think previous support is likely to now turn into resistance, and that previous support to me really lines up near that 392.50 mark. So if we do get any retest of that level from the underside here in this coming week or weeks, I think that would make for a really nice opportunity to play this downtrend back towards the midline. The stop in that case would be outside of these two highs, in which we're really looking at those highs to hold as part of new lower highs in this longer term downtrending channel. Now the midline currently inside of the S&P is taking us near that 365 mark. So that's where we're looking at the S&P to continue flushing until, at least for the midline to be hit inside of this trend. Now that doesn't mean this will happen right away. We may very well see that test from the underside, which is the idea of using the support as resistance now and trying to play that move into the midline. Now if this downtrend is likely to continue, that means we're likely to see these lower highs or lower lows, continuing to keep shaping up along with lower highs to form them. Then we'd be looking at a lower low that takes us even below that 350 mark. If I zoom out, below that 350 mark, we have our COVID highs. And to me, it still seems way too unlikely that these levels remain untouched. That takes us near 340. So if we did make a move below this previous low here, we have that 350 to 340 mark, which creates a nice little zone that I think acts as a magnet where price may gravitate towards. So that's the longer term target. But the shorter term target that I think is much more likely is the midline of this overall longer term trend. We're simply just playing a move in the upper area of this trend line, what we expect to be as resistance, and trying to play that back down to the midline. That's what I imagine big money's doing as well. So one more time to recap, inside of the S&P 500, we have a longer term downtrending channel. We've tagged the top end of that channel most recently, breaking outside of what was a shorter term uptrend. We've had this free fall. We're now looking at previous support to turn into new resistance and looking for that to take us down back towards this midline. Now, one other thing that we can do is load in our utility labels here and use the market pulse, which is our indication of what the trend is in a given market, to take a look across different sectors and see which sectors are the weakest. Now, we're looking for the red labels here, and this is on the daily time frame chart. And there's two places that stand out. IWM, so the Russell 2000 as an index market, along with XLE. Both of these are places which are currently weaker than all of the other sectors listed out here. However, all of these other sectors that have orange labels are really close to really transitioning into this red label as well. And so hopefully that gives you an idea of just how many sectors are really in this very weird funk where they could go from a stage of distribution, that's orange right here, to a stage of deceleration, which tells us we have downward pressure. Let me make sense of that for you real quick. I'll load in our market pulse indicator, which is what these utility labels are based off of. Both of these are free indicators, and I'll leave links to download them in the description box below. The market pulse is a 10-period variable moving average line. It plots this line on our chart. We have really one of three colors. Red means we're seeing deceleration or bearish pressure. Green means bullish pressure. And gray means we're either in distribution or accumulation. The tutorial for the market pulse breaks down each one of those 4 stages in more detail. But if I switch over to IWM here, notice how IWM, that line is red and recently turned red, which gives you this idea that, hey, we're now starting to see selling pressure accelerate inside of IWM, a little weaker than the S&P 500. Same thing inside of XLE as well. So any pullbacks to the market pulse now are really nice opportunities to play this overall longer-term downtrend. So one more time to recap, we started with the S&P 500. In the S&P 500, we have this longer-term downtrending channel. That's the one we've been paying attention to now for a majority of this year, really starting the beginning of 2022, and it looks like that's going to take us all the way through the end of 2022 as well. We now had a retest at the top of this trend line. We're looking for the midline to be reached. Once we get to the midline, then we really have the luxury of not only break-even stops, but also the ability to try and see, hey, are we likely to hit that COVID high, or at least get close to it near that 350 price point. I hope you found today's video useful. I'll leave a link to all of the tools I used in the description box below. The Market Pulse and the utility labels are both free downloads, so be sure to take advantage of them. Take care, everyone. Good luck trading, and I'll see you in the next update.